Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Asmpt Limited annual report. Asmpt Limited offers a diverse range of businesses and services that cater to the semiconductor and electronics assembly industries globally. The company operates in two main segments: Semiconductor Solutions and Surface Mount Technology, SMT Solutions. Under its Semiconductor Solutions segment, Asmpt provides advanced packaging solutions such as laser dicing and grooving, fan-out, hybrid bonding, thermos-compressed bonding, and die bonding. It also offers IC and discrete solutions including silver sintering, wire bonding, metrology, encapsulation and singulation, trim and form. Additionally, the company provides CMOS image sensor solutions like inline solution, lens holder attach, curing, automated optical inspection, cleaning, active alignment, and test and calibration. Furthermore, it offers LED/photonic solutions that include fan-out leveling, FOL. In its SMT Solutions segment, Asmpt offers a range of services including printing, inspection, placement, storage, and software. The company also provides critical manufacturing of IoT data platforms, which enables the creation of connected devices and systems. Furthermore, Asmpt Limited offers agency and logistics services to support its customers' needs in the semiconductor and electronics assembly industries. With its extensive experience and expertise, Asmpt is well-positioned to provide a comprehensive range of solutions that cater to the evolving demands of the industry. Asmpt Limited market capitalization of $48 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Asmpt Limited holds a significant advantage in their industry. Asmpt Limited trades at a higher price-to-earnings ratio of 44 times and a higher price-to-book ratio of 2.8 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 35% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be attributed to various factors. On the growth side, bookings have seen a significant increase of 17.5% in FY 2025, with continuing operations also experiencing a rise of 21.7%. The company has also benefited from gains on disposal of joint ventures and other income. Furthermore, sustained demand for artificial intelligence, AI, solutions, data centers, and hyperscale cloud markets have contributed to revenue growth. The company's technology leadership in advanced packaging, continued investment in R&D, and capabilities have also driven growth. Specifically, the advanced packaging AP business has seen a 30.2% year-over-year increase, driven by thermocompression bonding, TCB solutions. The TCB total addressable market is expected to expand from $760 million in 2025 to $1.6 billion in 2028, with a CAGR of 30%. On the decline side, applications for automotive outside China and industrial remain soft, contributing to revenue decline. Market softness in surface mount technology, SMT, in Europe and the Americas has also been a factor. Lower gross margin from both semi and SMT segments have further contributed to revenue decline. Net income experienced a significant surge in the fiscal year 2025, with a year-over-year increase of 24.5% and a staggering 42.2% growth in Q4 2025. This substantial rise can be attributed to various factors, although they are not explicitly stated. In contrast, profit margins underwent a decline across different categories. Gross margin decreased by 198 basis points, BPS, to 38%, while adjusted gross margin dropped by 147 BPS to 38.5%. The operating profit margin is not explicitly mentioned, but the operating profit increased by 10.1%. The adjusted net profit margin showed a slight improvement, with a year-over-year increase of 64 BPS in Q4 2025 and 39 BPS in FY 2025. These mixed results indicate that while net income saw significant growth, profit margins experienced a decline across various categories. The company's financial performance indicates a positive trend in its operating cash flow. On page 10, there is no mention of negative operating cash flow, suggesting that the company has been generating sufficient cash from its operations. Further evidence of this can be seen on page 15, where it is reported that group-adjusted operating profit has increased by 21.7% year-over-year, YoY. This increase in profitability is likely to have contributed to the company's positive operating cash flow. The data provided on pages 69 and 73 also supports this conclusion. On page 69, it is stated that the company's operating cash flow is positive, with an amount of $234,119. Similarly, on page 73, it is reported that the company generated $509 in cash from operations in 2025. Finally, on page 149, it is noted that the company's operating cash flow for 2025 was $183,639. While this figure is lower than some of the other amounts mentioned, it still indicates a positive operating cash flow. Overall, these points suggest that the company is generating sufficient cash from its operations to support its business activities. Management's outlook on the company's future appears to be positive, driven by significant growth in bookings and revenue. The company has set a revenue guidance of $470 million to $530 million for CONE 2026, indicating a sustained upward trend. This optimism is fueled by strong demand for technical component business, TCB, in Asia, which is expected to drive profitability through investments in infrastructure and technology development. Management's strategy focuses on optimizing the portfolio, streamlining operations, and driving growth through strategic investments. The company plans to hold unlisted equity investments for long-term purposes, indicating a commitment to strategic partnerships and collaborations. Overall, management's outlook suggests a confident approach to navigating the industry's challenges and capitalizing on emerging opportunities. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, businesses, or subsidiaries during the period under review. This lack of activity suggests a stable and focused approach to business operations, with no major changes to its portfolio or structure. The company has a history of rewarding its shareholders through various means. In terms of dividends, the company has consistently paid out dividends since 2025, with no changes expected for 2026. This indicates a commitment to returning value to investors. In addition to paying dividends, the company has also been actively buying back shares in the market. This strategic move aims to reduce the number of outstanding shares and increase earnings per share, thereby benefiting shareholders. The share buyback program was initiated in 2025 and is expected to continue as a key component of the company's capital allocation strategy. There are concerns about inventory buildup in the recent report. The issue is highlighted on multiple pages, including 21, 22, 23, 24, 25, and 105, where one-off write-offs and impairment losses suggest potential problems. These indications point to a possible accumulation of excess inventory that may be weighing down the company's finances. However, despite these concerns, there is no clear indication of supply chain disruptions in the report. This suggests that while the company may be struggling with inventory management, its ability to source and deliver goods is not currently at risk. That concludes the financial summary for Asmpt Limited. Feel free to comment below, and I will be happy to answer them when possible.